Every January, investors feel the same pressure. New year, fresh capital, new predictions everywhere. Everyone seems to know what will work and what won't, and that's usually where mistakes begins. Because most investors don't struggle due to lack of information, they struggle because they start the year asking wrong questions. So this video is not about which market will perform in year 2026. It's not about what to buy, sell or avoid. It's about resetting how you think as an investor so that your decisions are driven by process, not prediction. Whether you are starting your investment journey or you have been investing seriously for years, this mindset reset matter more than any market outlook. Before we talk about investments in 2026, we need to fix how investors should approach investing itself. In this video, we will look at what investors try to control but should not, what they often ignore but must get right, and finally, the questions that actually matter for 2026 for generating long term wealth. Let's start with the first problem. Most investors begin their year trying to control things that are simply not controllable. This applies equally to beginners and experienced investors. A very common behavior at the start of the year is asking which market will do well in 2026. It feels like responsible question. Forecasts sound intelligent. They give a sense of preparation. Media discussions, social content, and even professional reports are full of outlooks. But here's the calm truth. Long-term investing does not require correct prediction. It requires a process that works even when predictions are wrong. If predictions worked consistently, long-term investing would be easy, and it isn't. Think about it for a moment. If no one could accurately predict the last few years in advance, why do we expect this year to be different? Markets don't reward people who guess the future correctly. They reward people who stay disciplined when the future is unclear. The second way investors try to feel in control is timing. Beginners often wait for clarity before starting. Serious investors delay increasing investments or rebalancing, wait for comfort. This feels logical. Nobody wants to start at the wrong time. But here is the issue. Time spent waiting quietly erodes discipline even if the market don't move. Long-term wealth is not built by finding perfect entry points. It's built by staying consistent throughout imperfect ones. Time in a disciplined process matters far more than timing the process itself. Waiting feels safe, but over the time, waiting often becomes the real risk. Now, let's move to what actually matters, the areas investors can control but usually overlook. This is where real long term value is created. One of the biggest thinking error in investing is focusing on returns instead of purpose. Beginners often ask, how much will this give me? And more experienced investors ask, is this beating the market? Both questions miss the point. Investments exist to fund life goals. Returns are byproduct, not the objective. A portfolio without a goal is just a collection of numbers. When goals are unclear, investors react emotionally to short term outcomes. When goals are clear, volatility becomes tolerable. Before adjusting any investment in 2026, the better question is, what role does this play in my life? Another area investors underestimate is asset allocation discipline. Many portfolios end up diversified randomly. Others became heavily weighted towards whatever performed well recently. This feels safe, familiar assets feel comfortable, recent winners feel reliable, but allocation is not a reaction, it's a long term decision. Good portfolios feel boring most of the time. If your portfolio feels exciting, it's probably taking more risk than you realize. Asset allocation is about balance, not brilliance. And discipline here matters far more than picking up the next winner. This is one of the hardest part of investing, especially for the experienced investors. When nothing is happening, many investors feel something must be wrong. Boredom starts to feel like inefficiency. But this is dangerous. Investors often confuse activity with progress. Quiet periods are where discipline actually compounds. Compounds work quietly, but most investors don't. Doing nothing, staying invested, staying aligned with your plan is often the hardest decision and the most valuable one. Now let's bring everything together. The biggest reset for 2026 is not changing investments, it's changing the question you ask yourself. Instead of asking what should I buy in 2026, which market will perform best, should I change my strategy? Start asking, is my investment process strong enough to survive uncertainty? Am I reacting to noise or following a plan? Does my portfolio still reflect my life goals today? What should I not change this year? These questions don't create excitement, they create durability, and durability is what long term investing actually requires. If you are starting or restarting your investment journey, you don't need a perfect start, you need structure and consistency. If you are already investing seriously, you don't need constant change, you need behavioral discipline. 2026 does not need better predictions, it needs better investor behavior. The most important investment decision you make this year may not involve money, it may involve how you choose to think. And that's the foundation we will keep building on throughout the year. Thank you. Happy investing.